Welcome to MoneyWise on 938 Live. Joining us this morning is Dennis Ng. Dennis Ng, he's the founder of MasterYourFinance.com, and talk about the issues we didn't get to last week. And basically, Dennis had a problem with the fact that I said that you have to take a high risk to get a high gain. Good morning, Dennis.
Yeah, good morning, Keith.
So, Dennis, is that a fallacy that I need to take a higher risk in order to make more capital gains?
Yeah, that's right. It's actually a very common misconception. A lot of people always say that high risk, high return. In actual fact, it's possible to even have low risk and high returns. And of course, some people will have the experience that when they took high risk, it results in high losses, not any gains at all. So high risk, at most you may get high potential return, but it doesn't guarantee high returns. But it's possible to have low risk and high returns.
So how do you do that, Dennis?
Yes, the fact is that the real investor, the very good investor and experienced investors, in actual fact, they look for favorable risk-reward trade-off. That means for every risk I take, I need to be rewarded at least twice. So, for instance, I have a very simple rule. Whenever I want to make an investment decision, I will assess the downside risk. And I also will assess the upside potential. So I have a very simple rule that the upside potential must be at least twice of the downside risk. Only then would I be interested to risk my money. So in actual fact, I'm trying to minimize my risk and try to maximize my returns. So wrong, I don't do high risk, high return. In actual fact, I try to, most of the time, I take half the risk and double the returns.
But isn't that what everybody wants to do? Maximize their risk for the least possible, maximize their gain for the least possible risk. And we're all told about this mitigation of your risk. So how do you do that?
Yeah, you see, so the problem is most people don't even know how to assess the downside risk and the upside potential. You know, just now what I said, it seems to be very simple. But in actual fact, for each investment, you must know how to assess the downside risk. So for instance, let's say you want to buy a property stock. How do you assess how much is this property company actually worth? How do you assess if you buy this stock, let's say you buy Capital Land at $4, what is the downside risk? How do you assess that? What is the upside potential? How do you assess that? And of course, that I can't pitch or share in this 2-3 minutes time. So, but basically, it's not so simple to know how to assess the downside risk and the upside potential. But I have to say that a real investor, a very experienced investor, will always do this, and he always try to make sure that he will only take action if the risk-reward trade-off is in his favor. So in my case, I only take action if the upside potential is at least twice of my downside risk.
Thank you so much, Dennis. Dennis, of course, if our listeners have more questions, they can always go to your website, which is www.masteryourfinance.com, which is a financial education website. Dennis, thank you for joining us this morning on MoneyWise.
Thank you, Chief.